Hello, ladies and gentlemen. Thank you all so much for being here with us today, live from the VALK headquarters in London. My name is Antoine Lott. I am the co-founder of VALK, and on behalf of all of our team and our partners at London Blockchain Labs, we're glad to invite you to the first VALK series event focusing on the tokenization revolution and what lies behind the hype it has generated in the last couple of years. This event has been organized by VALK. We are an end transaction solution for private markets, which is today the leading tokenization platform on the Corda blockchain focused on private markets. We have joined forces with London Blockchain Labs, the #1 student hub for blockchain in the UK, gathering the blockchain societies of LSE, UCL, and Imperial College, and led by Dagan Reed and the team that are here with us today. In addition to London Blockchain Labs, we have partnered with Blockchain at Columbia University in New York for promotion of this event. I will now, without further ado, hand over the stage to Shermin Voshmgir, author of the widely acclaimed book Token Economy, available on GitHub for those of you that are interested. After her introduction to tokenization, we will welcome on stage Keith Baer from Cambridge University, Ferdisha Snag from Cleary Gottlieb, Carl Griddle from Bain Company, and Jade Talvaca from R3. The panel will be moderated by Jan Apache, Market Evolution. You can, of course, ask any question you want at the end of the session, and a recording of the event will be provided to all of you on all of our partners' website and social media. Thank you again very much for being here, and enjoy the show.
So, thank you very much for inviting me. I will be sharing my screen. So an intro to the token economy in 10 minutes is quite a stretch, but I'll try my best. So what is the token economy? If we look at it from kind of historic perspective of the evolution of the web, we can think of the web kind of one in the early 90s information revolution. It brought us the information and communication economy. The Web 2 kind of matured the web, and it revolutionized interactions. It was a front-end revolution, which made the front end much more usable. And by that time, we had figured out the different ways with which we could kind of put simple websites into use, and all of a sudden we had all those platforms emerging, from social platforms and knowledge platforms like Wikipedia and e-commerce platforms, etc. The Web 3 in this context can be seen as a back-end revolution. It changes the way we collectively manage data in the back end, and on the front end, kind of the killer application is the token. And the tokens are kind of rights management tools with which we can manage any type of right or value. So before we deep dive into what a token is and the different token use cases, an important word maybe to kind of what is different, how the Web 2 differs from the Web 3. Think of the Web 2 was a client communicating with a server in the backend, a server that is managed by a public or private entity, and we have no idea what happens behind the walled gardens of this server. The Web 3 is different, maybe not so much on the front end. The only thing that changes on the front end is that the kind of decentralized application also has a wallet. The wallet is the key infrastructural component on the user side that communicates in the backend with the blockchain network. And this peer-to-peer cloud, as opposed to the centralized cloud, is collectively managed. And one component in this Web 3 are distributed ledger networks, blockchain networks or similar distributed ledgers, and collectively manage all nodes in the network, collectively manage the state of all tokens. And so in the back end, kind of the key infrastructural component are the nodes, in particular the full nodes that have the entire ledger history of all the token transactions ever made. And but for the Web3 to properly function, we also need distributed databases, metadatabases, computing, peer-to-peer computing, peer-to-peer file sharing, etc. So the big game changer is that we collectively manage this public infrastructure, and the concept of the computer and the internet merges the Web3. Now, the killer application, why is the token the killer application? What is the token? Think of tokens as like tokens in the English language, all native speakers out there are not a new thing, right? We've had asset tokens in the form of shells, beans, money, as we know it, jetons, chips for a long time. We've had access right tokens in the form of tickets, ID cards, identity tokens, or membership cards. But we also know tokens from computing. They manage access rights and can manifest as QR codes or parcel tracking codes, as we can see on the screenshots below. But we also know the concept of incentive tokens from behavioral psychology and behavioral economics in the form of reward miles or other loyalty programs. So what makes kind of a Web3 token different from existing tokens? Well, these Web3 tokens, think of them as very effective rights management tools. These tokens are collectively managed by public infrastructures, in particular or in concrete by all full nodes in a distributed ledger network. And they can represent a set of different rights. One of the most important rights we will be talking about today are ownership rights. When we talk about asset tokens, and I believe this will be the focus today, ownership rights are key. But we can also manage many other different rights tied to an identity, like access rights, voting rights, and management rights. And I think what is very important to understand is that because tokenization allows a simple kind of management kind of issuing and management of these different set of rights, the concept of ownership might merge when you tie kind of extra attributes to ownership, like voting rights or access rights. We will look at it a bit later. And Web3 tokens are managed by the user with a wallet. So a user needs a wallet to authenticate and to manage their tokens. All right. So this wallet is, and this is also very important to understand, a node in the network, and any user needs a wallet to manage their tokens. And this can run on a mobile phone, but when it runs on a mobile phone, this wallet is a node in the network, but it's usually considered a light wallet if it doesn't have usually a mobile phone doesn't have the full ledger history, and it's a light wallet. And it manages, and this is very important, the public-private key pair needed to authenticate user. So think of a wallet combining functions of the real world of keys, ID cards, money, and investments, which means security tokens and other asset tokens. So I won't deep dive into everything that's on this slide, but basically it's key management combined with address management, combined with identity management, combined with asset management. Why am I repeating this over and over again? Because the concept of assets are merging in the Web3. And since we will be focusing on assets today, it's very important to understand where the journey is going. And we have to kind of try to think out of the box to understand kind of the redefinition of assets possibly in the Web3. Okay, so for types of tokens, in my book and generally I consider 4 different classes of tokens from today's perspective. We have the class of asset tokens. As I said, we will be focusing probably on that today. Anything, currencies, commodities, but also non-fungible tokens such as more complex securities, real estate, shares, art, energy, ownership of media, songs, movies, books. Now, these are probably the types of tokens most of you have been thinking of lately much, but we have many other token types as well. One group is the credential and attribute tokens, tokens that represent anything that is tied to your identity, such as a diploma, any type of certificates. We have a lot of pilot projects around COVID certificates on distributed ledgers, etc. Licenses, passports, and other ID all these kind of personal credentials and attributes, or even data trails can be managed through these credential and attribute tokens. They require our decentralized identity systems, and we don't have those standards yet. The community is working on those standards, but we don't have a winner-takes-it-all solution. So all the applications that would build on top of that are yet to come in a mass market. The access right tokens also build on the fact that we need kind of robust and decentralized identity systems for this Web3. And once we have that, we could tokenize any tickets, flights, train tickets, subscriptions to music, movies, books, memberships, and anything we're doing in the sharing economy now. So we can have a peer-to-peer sharing economy rather than a kind of platform token or a sharing economy. And then probably the most disruptive use cases is around incentive tokens, tokens that incentivize a network, a decentralized network. And so Bitcoin, for example, is an asset token on one hand because it's a cryptocurrency, right? But on the other hand, it's also an incentive token because a Bitcoin token is used to incentivize productive functions in the network. So we will be looking a little bit at that if we have time, probably not. So maybe I'll go into that now. So if you perform useful operations in the Bitcoin network, you can get reward with newly minted Bitcoins, which we refer to as Bitcoin mining. But the mining is not done out of thin air. You only get tokens when you perform useful operations for the network. So as such, Bitcoin tokens have asset function, incentive functions. It's very, very important to think of tokens in terms of functions. All right. Zooming out, big picture of tokenization. In the long term, I think tokenization will disrupt banking and finance. Asset tokens will disrupt banking and finance as the basis for DeFi applications. Purpose-driven tokens, incentive tokens will disrupt organizations. So we're redefining organizations over the internet. And identity tokens or credential and attribute tokens and access right tokens will revolutionize anything around identities and certification. Right. So let's focus on asset tokens because that's the focus of our session today. Asset tokens allow the creation of any digital representative for any physical or virtual asset and could introduce a range of new asset classes that have not existed or been feasible before. So when we look at asset tokens, there are two things that are important to keep in mind. Asset tokens can represent any physical or virtual asset, right? So it's not only virtual assets like cryptocurrency, but we can now also tokenize physical assets. And the next aspect that is important in the concept or in the context of asset tokens, and we've heard of it lately a lot, is the fact whether an asset is unique or identical. So if an asset has identical attributes such as a currency, fiat, virtual commodities, or fractional tokens of unique assets, they are called considered as fungible tokens. The first tokens over in the beginning of the Web3, we only or almost only had kind of fungible tokens, money-like tokens that had identical attributes that didn't have much more attributes than amount of tokens and price of token, right? What we've been seeing now is that the tokenization of assets with unique attributes, the so-called non-fungible tokens, this is getting very, very interesting. Tokens that represent assets that are tied to an identity or that have unique attributes, such as a piece of real estate or art, things that are tied to an identity or anything that is related to credentials or kind of reputation, etc. So unique attributes. This class of non-fungible tokens, this is something we're slowly understanding, and we're seeing the beginning, this hype around the art tokens that are misleadingly called non-fungible tokens. They're like art tokens, and like any token that has more a set of attributes that are unique is a non-fungible token. Some of them could be used for art purposes. All right, so we will hear a lot about payment tokens, stable tokens, central bank digital currencies in particular today. So I will not deep dive into that because we don't have the time. And then I think the speakers after me will be talking a lot about that. I think central bank digital currencies are a big, interesting kind of gateway drug to this token economy. If you're interested to see what is happening around CBDCs, there is a really interesting website called cbdcter.org. It's probably not super complete, but it gives a good overview. Beyond cryptocurrencies and anything that is either a virtual currency or represents a real currency as a central bank digital currency that is fungible, we have the set of non-fungible tokens. And while securities could be fungible, they can also be non-fungible. You could have special voting rights tied to a token, a security token. You could have management rights tied to a security token. So securitization or tokenization of securities will not only bring more efficiency in the settlement of tokens, but it can also introduce more interesting asset classes that haven't existed before because of the unique identities we can, or unique attributes that we can tie to them. We can also use non-fungible tokens for tokenizing real estate, tokenizing a unique piece of real estate and then fractionalizing it. And this might create super interesting dynamics, create more inclusion. Same is for art. We've seen just the peak hype of big selling prices, but there are many more interesting use cases in the art world tied to tokenization and NFTs in particular. And we can use NFTs for certifying diplomas, etc., anything tied to your identity. We can use NFTs for creating, or tokenization in general, to creating tokens that represented kilowatt hour of energy. And there are very interesting projects happening here too, where you can not only have peer-to-peer energy trading, but also proof of provenance of where the energy comes from and whether it's clean or not clean, whether it's local or not local, etc. That, however, requires that all players along the value chain of the energy market have a crypto wallet and crypto accelerators in their devices. And I think last but not least, the most interested aspect of tokenization are data tokens. Already entered the data economy with the Web 2. Like data has value, but it's currently being kind of bargained behind the walled gardens of these servers. And we have interesting new protocols like the Ocean protocol starting to monetize data with tokenization. So this will open up a whole new asset class that we haven't seen as such before in that context. I'm not going to deep dive into incentive tokens other than saying that we're moving away from these type of structures, kind of organizational structures, and defragmenting kind of organizations, making them more kind of peer-to-peer through distributed autonomous organizations and autonomous stakeholders. This merits a conference on its own. And so the incentive tokens or tokens that incentivize peer-to-peer networks are, for example, blockchain networks, blockchain network tokens, but also social media tokens such as Steemit, or basic attention tokens such as BAT or CO2 tokens in different forms. And here I'm not talking about CO2 offsetting, but incentivizing proof of CO2 emission reduction. To wrap it up, an outlook. if we look at these 4 asset classes I mentioned before, or token classes I mentioned before, I think that asset tokens are the gateway drug of this token economy. I think, and the more interesting things are the 3 other categories. The most important game changer, I think, will be the incentive tokens. Because the incentive tokens that incentivize personal contributions to a network towards a collective goal. And it kind of merges the concepts of, don't take me by the words, but like capitalism and communism. You incentive the individual towards a collective goal, and it affects the role of value creation and return on investment calculations as we know it. And to end this whole thing and to give an outlook into DeFi and asset tokens, if we look at the markets, we've looked at or analyzed up until today or before Bitcoin, we differentiated between capital markets, commodity markets, money markets, derivatives, etc. These were the type of markets we had. And then Bitcoin came along, and after Bitcoin, we started to include a new kind of asset class, and we called it crypto, and we defined the markets as crypto markets. And now we have this data economy, we're tokenizing data, and we have tokenized data markets. But I think where the journey is going is we will be eventually tokenizing everything. Now, certain assets that are transferable and can be traded, that are not tied to your identity, they're the pink ones. So in the end, everything will be a tokenized market, a crypto market. And then we will have kind of tokens that are tied to your identity that can't be transferred or have limited transferabilities, and these tokens will also introduce very interesting aspects. But what might happen in the future is that our concept of money, finance, and the real economy will merge. And we could enter a digital barter economy where the role of current money as was needed until now might not be that essential anymore. If we have peer-to-peer atomic swaps, where I can wallet to wallet trade my Apple tokens for my, I don't know, Euro tokens, and I just have to determine kind of unit of account for my own head, but then the algorithm will determine the swap rate. We're not there yet at all. But this is where the journey could be heading. But what I think will happen for sure
Shermin?
is that these markets will merge.
Can you hear me?
Yeah.
Yeah, sorry. Just being concerned here, could we try to reach a conclusion on your segment?
Yeah. That was the last slide, actually. So I think this is where the journey is going. And if you're interested to learn about more, I wrote the book Token Economy. It's available for purchase, but also online for free on GitHub. So very much looking forward to the discussion now.
Right, I think we're ready to start. So thanks again, Antoine, for inviting me to moderate this panel. I'm really looking forward to it. We've got some fascinating speakers, and apologies to the audience that you won't see more of me. I'm just being a disembodied voice today due to technical issues. So our panel today, we've got Carl Griddle, who's a senior manager at Bain Company, Keith Baer, who's a fellow at Cambridge University Centre for Alternative Finance, Fadisha Snag, who's a senior attorney at Cleary Gottlieb, focusing on financial services law and regulation, and Jed Talvachia, who's the head of corporate development at R3. And just to get things going, I'd like to go around each speaker and ask them a question to kick off. Of course, if any of you have comments, you're all welcome to pile in as well. I'm just here to keep the conversation going, and I'll also try and keep an eye on the Q&A as well, and feed in some questions live from the audience where we have the opportunity to do so. So let's start off with you, Carl, because I believe it's your paper that sparked off this whole conversation in the first case. Where do you see, following Shermin's amazing and detailed introduction, where do you see some of the biggest opportunities for tokenization, particularly in financial markets?
Yeah, absolutely. So first of all, hello from my side. I'm Carl. I'm a senior manager at Bain in Zurich. So my job is to work with financial services players, incumbents, startups, as well as private equity funds to basically grasp the opportunities that digital ledger technology introduces to financial markets infrastructure. And when we do this strategy work with our clients, we typically take two perspectives: the present forward perspective and the future back perspective. And the intro heard very much resonates with our future back perspective. So in the long term, there's huge potential in tokenization, or more generally speaking, distributed ledger technology in financial markets across all dimensions, be it clients, markets, asset classes, value chain steps. At the same time, what our clients are interested most is, what are the immediate steps that I need to take, depending on my current strategy and on my current footprint, to basically grasp these opportunities or to secure future strategic optionalities. And this is what we call the present forward perspective. And from the present forward perspective, what we think is that the biggest opportunities lie in private markets. Private markets meaning private equity, private debt, real estate, simply driven by the size of the markets compared to the public markets and the growth rates. Private markets have outperformed public markets in growth in the last 2 decades by 4x approximately. So we look at private markets, private equity, and very specifically in use cases that relate to automation, digitization, transparency in pre-trade and trade processes and also post-trade processes. And from there, eventually, a more liquid secondary market will evolve, then also leading to the benefits that we have heard in the introduction. So that's a bit how we see it, and what is the result of the study that you have mentioned. So very excited to talk a little bit in more depth in that discussion.
Thank you, Carl. And you've touched on a few things there. So automation and the potential for introducing efficiencies in the trading process as well, which I'm sure we'll come back to later in the conversation, as well as the questions around liquidity, which we'll come back to as well. So how do we develop liquidity in markets for tokens? Jed, on to you. And in your role as well at R3, you must see a lot of interesting ideas around the applications of tokenization. Can you share a bit of your insight on those?
Sure. Pleasure to be with everyone. My name is Jed Tavakia. I head up corporate development for R3. I wear 2 hats. One of those is a more traditional corporate development, thinking long-term acquisitions, divestitures, and partnerships for R3. The other is I run a small venture capital fund that is captive to R3 that invests in applications that are platformed on Corda, particularly Corda Enterprise. To your point around kind of what does the deal flow look like and where kind of interesting opportunities, I would say one of the commonalities that I've seen in this phase of Web 3.0, and I thought Shermin's introduction was fantastic. We're still kind of in that nascent emerging technology of 3.0, and I think there's a lot of promise in a number of areas. And some of the best go-to-markets that I've seen for these applications have started with a workflow processing front end that is elegant and replaces kind of entrenched incumbents in a lot of paper-based processes that you still see in insurance or in capital markets. I'm thinking of syndicated loans, which still take 2 to 3 weeks to settle, right? And that doesn't actually leverage a blockchain platform, right? It's simply about getting paper-based data digitized, right? And what the promise is and how the kind of the hook is, where they've been able to succeed, where others have not, because of course digitization is around since the dawn of the computing age, right? Why have we not digitized some of these insurance processes or syndicated loans? Is that second piece that Carl was just talking around that promise of secondary markets and liquidity there. right? So you're able to say, hey, look, if you digitize these previously illiquid assets, right, like a small real estate development, right? Maybe a family office, a high net worth individual backed, small real estate development. Usually that was illiquid. They're not going to REIT it. They're not going to float it publicly, right? And so how do you kind of unlock some of that value in the development? Well, previously it was very difficult to do that. And now you've got an opportunity, right, to access secondary market via Web 3.0 and kind of on a distributed ledger, right, where you've got the costs to ownership, to verification of that ownership, and to trading have all come down precipitously. So I think that's where we see a lot of the commonality in the applications that we're looking at, which is that kind of digitization of the front end and then layering on a secondary market in the back end. Now that secondary market is yet to develop, right? And I think the smartest players are upfront about that, to say, we will build out piece in the coming years, right? As you start to create network effects on the platform, and they know that they need to crawl, then walk, then run, and they're not trying to kind of achieve that utopian vision in the first year of development. So that's kind of what we like to see, where people have kind of thought about what the path to the total vision is, but then broken it up in smaller chunks to get there. It's an easier use of capital, and kind of you can see the gating factors all along the way, and it makes it easier to kind of grow the business. Let me stop there. I know we've got a great panel. I don't want to take too much time.
Thank you, Jed, and I think we will dive more into a lot of what you've said further on in the panel as well. What you really alluded to there is the importance of developing a marketplace and the market infrastructure for the trading of tokenized assets. And Keith, perhaps this is an area that you can shed some light on. What do we need to have in place in order to have successful markets for tokenized assets?
Great, hope you can hear me okay. So yeah, just to introduce myself quickly, I spent many years working at IBM. The most recent years before I left in 2019 was working with financial market infrastructure providers on their implementation of blockchain along the lines of what Jed was talking about, basically removing cost, increasing efficiency through digitization using blockchain, but not anything in the token world at that stage. So to answer your question, I think you can look at along three dimensions. One is the digitization of assets, tokenization of assets. And as we've already seen, there are many examples of that already: real estate, collectibles, art, etc. So that's going on at a pace. But still, there's only scratching the surface. For example, numbers vary, but I think something like $100, $200, $300 million of real estate may be tokenized already by various startups. But the total real estate market in its entirety is worth about $280 trillion last time I looked. So we're only scratching the surface of where the potential is, and there's a long way to go, first of all, in terms of tokenization. Secondly, as was touched on as well in Shermin's presentation, there's a need for tokenization of cash, so the other side of a transaction within a trade kit. Obviously, that's been developing for some time in the crypto asset world, Tether, etc., but it's still fairly nascent as far as the traditional financial markets are concerned. But there are examples like Helvetia running in Switzerland with the SMB and SIX, Finality, which may be going live by the end of this year, for example. And obviously CBDC has been mentioned earlier as well. So both those examples, I think the ongoing tokenization and being able to hit scale and the tokenization of cash leads into the third dimension, which is the markets themselves. So if you have those two elements and you have the other key elements that are required, marketplaces that participants trust, that they may be new entrants like Archax here in the UK, for instance, running on Corda, as Jed knows, or maybe traditional exchanges. We've done a lot of work from a Cambridge point of view. I'm a fellow at the University of Cambridge, and one of the projects we did was with the Stock Exchange of Thailand as part of their digital assets program, which they're due to go live with the first phase of that later this year, for instance. And that's all about trying to understand how these things come together using a trusted entity like the Thai Stock Exchange, but creating a new digital exchange alongside the main market. The other kind of, just to finish off, key developments that are required, I think, are the custodial services. We now have obviously following Fidelity and others that are offering custody services for digital assets. And it's the combination of those three things, I think, advances in the tokenization of the digital assets themselves, the creation of cash on a ledger which can facilitate a settlement, and then the combination of the various elements of market infrastructure that certainly institutional investors can trust, because they're either entrants that meet all the criteria from a regulatory point of view, or there are existing market infrastructure providers that have moved to develop the necessary functions and features to facilitate a digital asset marketplace. So I'll stop there.
Thank you, Keith. And Fiducia, last but not least, obviously these are not new concepts when it comes to financial markets, but there is new technology that's underpinning them, and it's the technology that often doesn't, and the implementation of some of these concepts that often doesn't easily sit with our existing legal and regulatory infrastructure, I think. So can you tell us a bit about what are some of the key legal challenges that are surrounding tokenization, and how are different jurisdictions responding to these?
Thank you very much, Shanna, and thank you to VALK for the opportunity to participate in this panel. So quickly, I'll introduce myself as others have. I specialize in financial services regulation in Cleary, Gottlieb, and Hamilton. I work for a range of financial institutions, so across the sector, and therefore covering a wide range of regulatory subjects. But what I really enjoy is sort of regulatory perimeter issues, and tokenization creates some very unique questions in that regard. And so to answer your question, I suppose first of all, let me say I'm focusing here on asset tokens because, as was said in the keynote, they really are the gateway. It's what is policymakers kind of sit up and pay interest. And so, as a lawyer, like in, other professionals in this space, we've observed the sort of, different waves of more or less enthusiasm for digital assets and DLT. And the regulatory response has kind of varied as well in that regard. But I would say despite that sort of history, at the end of it, the biggest challenge, I would say, kind of remains the uncertainty surrounding both law and regulation. And by and large, policymakers haven't tried to prohibit digital assets. There are some sort of options, of course, like in the UK, the prohibition on selling crypto-based products to retail investors. But by and large, it's still fairly permissive. But I think everyone will agree that it's quite difficult to navigate the legal and regulatory framework, and that's true in pretty much all jurisdictions, including in the UK. So if you start with questions of law in the UK, we've had attempts to try and address particularly what is probably the key question to all of this, whether digital assets, tokens are can actually be property. And in the UK, we've had legal experts say quite persuasively that yes, they which will be a relief to everyone who's kind of participating in this project. But that is the foundational question. We kind of still are at a stage where we need to do more in this regard. So we need to answer the question of what type of property, what do you actually hold when you hold a token, what exactly are the relationships between the holder and the issuer, if there is one, and then third parties. And then, this is sort of magnified if you think of it from a cross-border standpoint, because, this technology is inherently cross-border, is inherently international. And to state the obvious, it's decentralized. So in theory, subject to regulation, we can see the involvement of, non-traditional actors intervening in the infrastructure in ways that we kind of haven't experienced before. And so we need to solve, I think, still the question of the conflicts of laws. So which law, when you have a system where it touches on different legal systems because the participants are in different places, bits of the infrastructure are in different places, etc. Which law do we choose? And we haven't necessarily had a lot of success in settling that in traditional kind of securities, so it will be a real challenge there as well. And then there's a regulatory angle. Can you participate in the ecosystem or without needing a license. And if you need a license, then, how do you go about it? I think that question is not at present very satisfactorily answered in many jurisdictions, including, quite frankly, in the UK. The regulators are tending to adopt the principle of same risk, same regulation. So, if the concepts are similar to things we've seen before, then we should be applying, the same regulation, quite frankly. But, that makes sense as a starting point, but it can be difficult to apply in practice because the regulation is actually built around a particular type of infrastructure, which is kind of what we're used to. And so the other question is just how are people, different jurisdictions going about it. I think, quite frankly, people are thinking, which is great. So in the UK, we recently had a consultation from the Treasury, sort of, just trying to understand, the use of the technology. It focuses on a particular type of digital assets, so stable coins, but the Treasury is kind of not intending to stop there, and that's seeing that policy development is important. The other aspect of it is sort of sandboxes and testing. The Financial Conduct Authority in the UK has been very sort of successful in pioneering that, and sort of more jurisdictions are kind of following suit. A sort of sandbox approaches is something which in the European Union they're kind of proposing in certain respects as well. So I think I'll stop there, but yeah, that's would be my sort of initial response to that question.
Thank you, Felicia. I think something you've touched on there is the global nature of these types of tokenized assets, the fact that by virtue of their implementation, they're globally available, and this creates legal challenges, as well as being a key source of opportunity for innovation and for opening up new access and new markets. And I guess building on that, and I'd like to really open up the discussion to all members of the panel now. What we hear a lot about the hype around tokenization. So the hype is all around, you can tokenize anything and it will democratize access to investment, and it's going to change the world and the way that that people are able to invest and change the way that markets operate. It's going to, disintermediate expensive layers of intermediation, etc. I think from what you've said so far, you've made a clear case for the benefits that can be brought by automation, by cost reduction, by greater efficiency, by digitization as the next logical stage of evolution of these markets. But what are the other benefits beyond the obvious and beyond the hype that tokenization can bring? Can they really open up access to investment to a wider pool of investors? Is that something we even want?
I mean, just to kick off, I think it is something that is wanted. We did a project, for example, with a very large global asset manager sitting on several $1 billion worth of real estate. And they saw significant benefit in terms of tokenizing, just in terms of being able to increase the liquidity of the assets in that respect through fractionalization. So that has always been, I think, one of the mantras for tokenizing of large illiquid assets such as real estate through tokenization. Though what was interesting, I saw a presentation from State Street a couple of weeks ago, which had something like 35% of the institutional investors they were talking to rating liquidity as being one of the key reasons why they would see assets being tokenized. But way above that, around 62% was risk management, 55% was enhanced security, and 55% was transparency. So there's all sorts of additional benefits, I think, beyond the obvious ones of liquidity and the impacts that fractionalization has on that.
Thank you, Keith. Would anyone else like to add to that?
Yeah, I mean, I would echo the risk management tools. I mean, I think one of the famous stories from 2008 is, calling up AIG and saying who owns the other side of the CDO tranches there on Lehman, and nobody knowing because they've all been traded away, right? And being able to understand where that risk lies in the system is a key benefit for regulators. So even if you think about a purely DeFi world, the ability to see where assets have moved, at least, because that is public, whether it's Bitcoin or Ethereum, right there, those are public chains. you can see where risk is moving. So I think that's, on the macro side, important. But even on the micro side, I think even taking back ownership of your own data in Web 3.0 and being able to get paid for who is accessing your identity to sell you ads on Facebook or Instagram or any other sort of thing, that is another kind of on the micro, the most micro level, on the individual level, right? A way that tokenized data and having a distributed identity, right, and self-sovereign, that you can then say, yes, if you're accessing my information, then I get a cut of whatever advert you show me, right? That's another promise. I think that's quite a ways away in the future. I know there are certain generations that have yet to even get email, right? Donald Trump was famously didn't have email. So I think the likelihood that we get that sort of prevalence in across all generations in the near term is somewhat limited, right? But I do think over the longer term, the idea that you can own your own identity and be paid for who accesses it is finally, there is a technology that allows that kind of inversion of the way Web 2.0 worked.
Thanks, Jed. And
just to jump on this, these developments are definitely wanted and sought after, especially in certain pockets or certain asset classes or certain areas in the industry. Generally speaking, issuers are looking to connect to investors. Yes. Two thoughts on that. We assume a staged approach. So it's if we say issuers and if we say investors, probably not the broader public in the first place. It's going to be a staggered approach. So, for example, the example of syndicated loans was mentioned. So maybe the first stage is to exchange these shares in a syndicate amongst the syndicate members, or in a private financing round or a deal arrangement. The first step is to exchange these shares across existing investors and then opening it up gradually. I think that's a bit what we have to have in mind, or at least what we see when we look at the industry. Another example could be corporate clients providing liquidity to employees. Yeah, so you have certain pockets or groups of investors where technologies are tested and then potentially connected to more broader, more public markets. And the second thought, in regards to the benefits, before these benefits can actually realize, there are also certain prerequisites that need to be fulfilled, and they are in the area of regulatory certainty, also regulatory standardization. A large benefit of DLT in theory is anything that moves cross-border. Yet, if you have different regulatory regimes across jurisdictions, these benefits are difficult to realize. Another benefit is anything that relates to atomic settlement, that was also mentioned, I think, earlier in the keynote speech. And theoretically, very interesting to settle any share on a blockchain against a CBDC on a blockchain, especially wholesale CBDC, when I leave out the payment aspect of CBDC for a moment. These are, in theory, very attractive benefits. However, the adoption of the industry and the current infrastructure that is in place still has some way to go until these benefits can actually be realized. And that's an interesting part where market participants move in now. How to ensure these prerequisites, to set that standards, and who to be first to shape that future.
And where are we in terms of industry adoption, both in terms of institutional investors and their interest in an adoption of tokenized assets as investment vehicles, but also in terms of financial market participants now, so banks, brokers, etc. Where are we in terms of their adoption, particularly on the issuer side? So those who are involved in the primary capital market space, or in enabling private financing. Is there to what extent do you have that institutional interest driving the development of these markets now?
And in my view, we're still early days, as I mentioned before. SDX, for example, the Swiss Digital Exchange, is meant to be operational later this year. EDX in Thailand, I mentioned as well. Archax only fairly recently got their license from the FCA in the UK to operate their exchange. Boney only a couple of months ago launched their digital asset custody services, for instance. These things are all fairly new, either in the last 6 months or the next 12 months maybe. But I think that, as I said earlier, I think they're all prerequisite to the institutional investors really having the necessary level of confidence in the regulation and the financial markets infrastructure to support those kind of challenges. And that has an impact, I think, on the issuers as well. Understanding, where the potential is going to be in terms of the overall environment that they need to work in to have confidence that issuing will be successful in that respect.
And what retail investors? So about, I think it was about 10 or 11 years ago, we saw the explosion of interest in crowdfunding and peer-to-peer lending as more accessible forms of investment for an accessible means of interacting with financial markets for retail investors. And regulators were initially quite slow to respond and a bit nervous of them, but then they did extend some of the existing regulatory paradigms. I mean, in some cases, particularly on the private market side, this is kind of an extension of that. And in DeFi, we're seeing an extension of the peer-to-peer paradigm as well, aren't we? So will we see more retail participation in tokenized asset markets?
Yeah, I believe so. I think Keith alluded to SDX work, and Archax has already been mentioned, and I think that's an interesting, kind of segmentation of where the market could go. SDX looking to serve institutional clients, right? Not just in Switzerland, but beyond. And I think Archax looking at kind of family office assets, right? That were previously illiquid there. And I think those are two, very, I would say, institutional or regulatorily friendly approaches, right? FCA approving Archax last August, and obviously SDX working hand in hand with the Swiss regulators to make sure that whatever offering comes to market, right, it has been blessed. So I think you can see, that is kind of the more institutional path there. But if you also take a look, you've got upstart exchanges that are thinking of, not going that path, right, in the DeFi world, that are looking to have a faster time to market, to tap retail demand. And I think, there will be a reckoning around some of those, right, in terms of what's legal, what is has the technological or regulatory foundations, right, to persist. But I do think you see coming at it from both sides of the market. And I would argue that DeFi tends to be able to tap into retail demand at an earlier point than kind of this idea of coming down from working with the regulators and starting those exchanges and then trying to tap into more retail demand.
Thanks, Jed. And I think with respect to the regulators there, again, there's a balance that regulators have to strike in terms of, their protection of market integrity, their protection of consumers, and also their role in encouraging rather than discouraging innovation. Fadisha, what do you think is the role of legal and regulatory frameworks in encouraging innovation and competition? And are there examples of jurisdictions that are doing this well versus those who are doing it in such a way that's stifling innovation in this sector?
Sure, no, thank you. I think that's a key sort of policy balance that has to be struck, because I think different actors in this space can have different incentives as to whether to adopt the technology, whether to sort of digitize assets. So retail investors, it's ease of access. It's you can sort of access these things on a mobile phone, etc. It's sort of interesting, very topical. For the more sort of traditional sort of infrastructure, it's probably just about streamlining existing processes, etc. And the regulation kind of has to deal with both aspects of that. Not just be not end up in a place where retail investors go after sort of very, quite frankly, riskier asset classes, and the traditional kind of sector remains, quite closed, and quite sort of centralized, and so yeah, that it's sort of balancing these sorts of issues is the main role of the legal and regulatory framework in all of this. That you kind of have to get the policy sort of right, and that's kind of where I sort of come to the question of, well, how do we get that right? Is it right that the starting point should be the idea that we regulate these things in the same way that we have always done similar activities, or should we be looking at the specifics of the technology, the demographics of holders, how holders understand the asset class and how it works, and the specific risks, as well as the benefits, and then decide kind of whether the regulation, what the regulatory framework should be like. And the other part of this is to develop for new businesses who may be sort of focused at retail or other non-traditional sort of markets, to allow them the space to test their products in a sort of small scale way. So in addition to having sandboxes, maybe look at things like thresholds. You can do a certain amount of business and target a certain amount of clients without attracting regulation in the first instance, and then we look at the policy there. So yeah, just to answer the question sort of very directly, the regulatory and legal framework is to get this right, because otherwise it will develop in ways that are not necessarily sort of beneficial and not necessarily in the best way for systemic risk. And then the second bit of the question as to whether there are jurisdictions which are getting it right and others which are getting it kind of wrong. I think to focus on the ones that are getting it right. I think the ones that are appearing to be thoughtful about it. So I'm also here with the UK and the EU, and I think there is thinking going on. There is there consultations and with industry to really work out what the best regulatory framework should be, and that must be the right approach, rather than something that entirely sort of top down and imposed. We must sort of find out where the technology is going and look at the regulation from that perspective, and just seeking to just prohibit things, etc., is probably not the best approach. And so those jurisdictions where that is the approach to kind of just stop it, it's probably not the right thing to do.
Thank you. And what about the rest of you as kind of consumers of regulation in a way, in some of the use cases that you see and that you work on? How do you believe that the regulatory environment is reacting to tokenization? Areas in which you think that it could provide better support or adapt the way that that regulation is being approached? I'm aware that this is not an individual jurisdiction question. This is about top-down approaches from the kind of multinational stakeholder level. Any thoughts on that?
I mean, just a couple of comments. Obviously, there's some top-down regulatory advice, for example, on the subject of stablecoins and what's been published by the Financial Stability Board, etc. So there are examples of this coming top-down as guidance to local regulators and how they may implement. Then here in Europe, of course, we have MiCA, and that's raising a whole set of new questions, I think, in terms of how MiCA will be implemented, when it'll be implemented, given some of the feedback that the initial regulation is getting before it becomes law, and what the impact is going to be some of the models out there, such as in DeFi that you mentioned earlier. So I think the kind of combination of the top-down and the some of these new regulations that are quite significant in terms of what their scope is and ambition and the impact that they will have. But it'll take some time. So, DeFi, for example, may be moving at light speed in terms of the innovation, but MiCA may take 2, 3, 4 years to actually come into operations. So understanding how these paths will cross and what happens when they do cross, I think will be quite fascinating.
Thanks, Keith. Jed,
Yeah.
you've come.
Yeah, I think there's, if you go back even 5 years, which is an eternity in blockchain, you still see a number of regulators that are at the forefront of trying to have sandbox experiments. So I think of the Monetary Authority of Singapore and Project Ubin and trying to think about a digitized Singaporean dollar. And I think there was commonality there with MAS, but also with the Hong Kong Monetary Authority at the time, and actually the Canadians with Project Jasper, where they are looking at ways in which to ensure in a 21st century and a digital Web 3.0 economy, right, that their currency can actually be either, if not a reserve currency, but perhaps the fungible asset, right, for transactions in that ecosystem, and to retain basically a money center position in the world economy. And I think now, if you just look at the last kind of 3-4 months, you see the OC in the United States issuing guidance to that effect. And I think you start to see, the Swiss or even the Swedes, right, to think about digitized currencies. And what is interesting there is kind of the money setters that are trying to jockey for position and maintaining, that foothold, like the Singaporeans, were at the cutting edge, whereas those that, the U.S. as the reserve currency, in the fiat world, could move a little slower, kind of, and perhaps rest on those laurels. But I think you're starting to see across all of the jurisdictions an approach to say there will be digital currency, and the question is, how do you regulate that, and how do you interact with that in a way that the reserve banks, right, find safe and prudent, but also not inhibiting innovation broadly across their financial ecosystems. So I think there is, at this point, that we're past the tipping point. I think everybody recognizes there will be a digital currency from here out. The question is how and in what manner will they interact? Will it be a tokenized stable, asset like a stable coin, or will there actually be a central bank digital currency? And I think we will see central bank digital currency in the next kind of 5 years. And I think that would be, a huge then second tipping point for the idea of having atomic settlement and having a truly digital economy. So I think we're moving towards that, but it is kind of a gradual evolution, especially in some of the more established money centers, where there hasn't been the same necessity to be on the forefront of innovation just to retain that toehold in the world economy.
Thanks, Jed. And you've also quite neatly segued us there onto the topic of digital currency, be it central bank digital currency or CBDC, or the rise in the use of stable coins, which of course was really brought to the forefront of the public's attention when Facebook announced Libra a couple of years ago. And there's a question in the Q&A, and I'm going to start going through the Q&A now, as we've only got a few minutes left, around the consequences of the tokenization of cash, and what can this mean for populations with limited access to technology? Won't it drive more of a wedge between economic classes? I think there has been a fair bit of discussion around both access to, the potential access barriers to digital currency, as well as the potential for digital currency to be used as a means of policy delivery and financial inclusion as well. What are this panel's thoughts on the broader opportunities that could arise from the introduction of a retail digital central bank digital currency, or the use of retail stablecoins, for example?
Just to comment on retail CBDC. So I have the pleasure to teach a course on that subject to global regulators. We have an online course from the university, Financial Technology and Regulatory Innovation. So we've had about 700 global regulators through that course. We're just starting the 6th cohort in June, I think it is. And what's come across out of that, we have a broad cross-section from large institutions like the Bank of England, for example, all the way through to the central bank in Bhutan, huge contrast. And what's clear is obviously many of the emerging market jurisdictions see great benefit from a financial inclusion point of view, as you mentioned. Obviously, especially those countries which have a large percentage of unbanked, where mobile phone penetration may be significantly higher than the banked population. So that obviously has direct benefits, especially with the feature that can be designed into retail CBDC in terms of facilitating offline payments, for instance. So I think there is a great potential as far as that's concerned. And as BIS's surveys have shown, this over 80% of central banks are actively considering CBDC, all the way from research all the way through to pilots that are running in China, notably at the moment, but also the live implementations of the Bahamas. And I think I saw the Eastern Caribbean Central Bank is heading into production already as well. So, the experience, I think, is growing at pace. I think Jed's estimate is probably not too far off the pace in terms of timescale, though I do remember Christine Lagarde said the digital euro she would expect in 2 to 4 years. So again, that sort of timescale, I think it'll be really interesting to see in China with the Beijing Winter Olympics, where the electronic yuan is meant to be making a more public appearance outside of the pilots that are running in 4, now 5 cities in China. So I think that would also be really interesting to see the state of maturity. But obviously there's a significant challenge in terms of how CBDCs are implemented. There are many types of design choices, including things like the interest rate policy, the design of maximum things, all sorts of things to ensure that central bank's main objectives are carried out. And I think that will be a kind of fascinating journey as we go over the next 2 or 3 years. And to your point of your question, I think will be a huge enabler of much of what we're talking about in terms of tokenization as well.
Thank you. We have another question on corruption and transparency concerns with tokenization. And I guess one thing we haven't really talked about is, again, with tokenization, what some of the wider benefits of having programmable assets can introduce. So many compliance challenges can be met through the fact that these assets are potentially programmable, including verification of investor identities or KYC type things. Do you think that these types of assets can introduce benefits when it comes to reducing financial crime, bribery and corruption, and money laundering, etc. as well? Carl, since you haven't said anything for a while, let's put you on the spot for that. Or more broadly, what are the wider benefits that can be introduced by having programmable assets?
So first of all, the transparency aspect is certainly one. And when you go into the programmability and you think of, post-trade processes in equity, for example, or the implementation of investor protection rules into the asset rather than enforcing that from the outside through regulation and control, there are definitely very interesting, benefits that could emerge. I think everything related to that we see now is more on a sandbox stage or on a experimental stage, and until this reaches a certain scale, we would have to reach a certain penetration of tokenization across more broadly traded asset classes like equity, like funds, for example, and the like. And this is something that, in terms of timing, is probably longer out than CBDC as a currency or a settlement instrument. In theory, yes, there are huge benefits. Practically speaking, a token-based financial markets infrastructure or a digital market infrastructure, if you want to call it for that matter, always has to compete with the existing financial markets infrastructure, which by and large has worked quite well and has proven to be robust even in times of high volatility and high trading activity in the last year. So the proof points for actual benefits and the market pain points is still to be brought. And that's, I think, also when we talk to our clients, really the the number one advice. The selling argument for DLT and tokenization is not tokenization itself, but looking into pain points that exist now, try to solve them, and then maybe as a, let's say, stage 2 benefit, realize everything that we have touched upon so far. That's how I would look at it.
Thank you. And let's see. We've got some very specific questions in the Q&A, which I won't raise since they'd involve the members of our panel speculating on specific companies, which I don't think they would want to do in a public setting. Let's see. Cyber risks, getting onto the slightly more technical side of things. We actually have had a couple of questions around how do you guarantee ownership? What are the kind of cyber risks of tokenization? If I buy tokens, what happens if I'm hacked, and that sort of thing? I mean, to what extent is some of this a technical issue versus an education issue versus perhaps even a legal certainty issue, somewhere where we just need additional legal clarity around recourse and things like that?
Yeah, please, I'll let the lawyer speak. No.
No, well, I don't have very much to say on that other than to sort of agree that there is the legal sort of answer to that. I think we still don't know, to be honest, what it is that you hold, from a legal perspective when you buy a token. And I suspect it depends on the particular protocol, depending on the asset actually. But there is a lot of learning still to be done, either among even among the sort of the institutional sort of sort of demographic to kind of understand that. That is a key sort of issue.
Yeah, I would absolutely agree with that. I think there's a space for developments and reforms in all three areas. So I think there is certainly a part here of education. There's technical, and then there's regulatory. And I think you see that with any new asset, right? So just to level set, I often think about, especially with Bitcoin, there's been theft of Bitcoin, but you've stolen cash out of the deposit box, the safety deposit box. You haven't stolen the plates at the mint to mint more cash, right? Or to mint more Bitcoin. That's the classic analogy. And so there's yet to be a hack of Bitcoin, right? Now, famously with Ethereum, there was, right, in terms of actually a shift over, right, from Ethereum Classic to what we now think of as Ethereum, right? And the whole community basically said we're going to move over, except for small holdouts, right? That was a technical issue, right, that was resolved through a human kind of agreement, and the consensus says we're going to use this new Ethereum protocol as opposed to Ethereum Classic. So you see kind of both a technical issue there, but also a human solution to it. And then you also have regulatory aspects of it, right? I think you think about the use of bearer bonds, right, which used to be somewhat common in capital markets that is now almost completely fallen away because of the risk of theft that they posed. And so you see things move away from, a technological innovation just to say we need bearer bonds anymore. We can do this all through, at that point, centralized ledgers, right, and kind of tracking ownership of existing bonds. So I think you're going to see kind of levels across the way, kind of in reforms on each one of those. But I think the areas where I've seen the major hacks that grab the headlines and that have probably some poor reporting in it don't make that distinction between whether it's Mt. Gox and it's the bank was fraudulent, right, as opposed to the underlying assets were hacked, right? So I think that's the important piece here. And most of these is that with some notable exceptions, Ethereum being the glaring, the hack is not really of the technology, it's of either the custodian, right, or have a consensus that then moves beyond a kind of a hack of the technology to a better technology, right? So that's kind of where I see things moving, but I think it's part of any new asset class. You've got to do all three at the same time.
Thank you. And I think final question, which is probably a good one for everyone to close on. So maybe 1 minute for each of you on this. We've had a question about business model disruptions. What do each of you think is the the greatest area, the greatest potential area for disruption in a positive way, to end on a positive note, in terms of use cases for tokenization of assets. And I'll just work my way around my screen. So Keith, starting with you.
Yeah, I think that's a kind of a tough question. The one that comes to mind immediately is the kind of crossover between DeFi and centralized finance. So we touched on DeFi, but obviously we haven't got into much detail. But I think it's going to be interesting to see how these two models come together one way or the other. I was on a conference, I think it was actually the BIS Innovation Summit that took place a few days ago, where the comment was made of being able to buy Joe Lubin, of wrapping CBDC and having it run on a DeFi network, for instance. So I think there's all sorts of interesting potential when these two worlds come together. And it's kind of hard to predict exactly what the shape of that will be. But it will, I think, give many new kind of opportunities, much new kind of areas for innovation. And I think how both the institutional side and the retail side come to trade and participate in those markets as the two come together, I think is going to be a fascinating journey.
Thank you. Carl, where do you see the greatest opportunities for positive disruption?
Yeah, let me look at it along the value chain, and I'm going to work my way backwards to the front. So starting with post-trade, from an overall industry perspective, yeah, if you look at the kind of industry-wide revenue pool, that's probably where the biggest benefits are and the biggest potential of disruption in settlement, custody, asset administration, and the like. Moving forward to trading, that's actually something that can almost exist in parallel. Not so much disruption here as, you know, it's still trading of an asset. So the stock exchanges and the trading systems, as long as they are able to handle these assets, the trading works similar to, you know, commodities or live cattle or cash equities. Yeah? And then moving one other step forward in the pre-trade, this is probably where, you know, where we see potential for disruption, absolutely, and where it's probably going to be most visible for investors, you know, because this is where new asset classes will be made accessible to a larger pool of investors, and that's probably something that, to end on a high note, we can all be most excited about.
Thank you, Carl. Pradesha.
So I would reiterate the larger pool of investors. Going back to the point about sort of more retail participation, it has been an ambition, in particular the European Union, to have retail participation in capital markets, and with so retail retail investing in Bitcoin, etc. Because that is happening. I think that will be a sort of gateway into some of the more traditional asset classes, and with that will come, I think, kind of financial literacy. I think there's already, I think, an increased kind of understanding of financial crime, maybe not as a sort of technical matter, but understanding that when you invest in something, you need to know where it goes, or else maybe you shouldn't invest in that. I think there's sort of more and more of that. So I think we getting that policy between where we sell retail from wholesale before and seeing how that works out will be key to all this, to my mind.
Thank you. And Jed.
Yeah, looks like we're perfectly on time, Donna. That's a great job as a moderator. So just on this last piece, I to actually wrap what my co-panelists have said is this idea of a democratization of finance, right, in a number of areas. And so I think from we've talked about fractional ownership of previously illiquid assets like real estate, right? All down to, kind of disintermediating even primary dealers for government bonds, right? Why is there just a small club subset that gets to interact with central banks and the issuance of sovereign debt? Can we democratize that down where you actually have more players bidding on that price and it's a much more transparent process, right? So I think the tokenization and the digitization of finance and removing intermediaries through smart contracts, I think, has huge opportunities for the speed of markets, but also for the stability of markets. We talked earlier about how do you see where risk is flowing in those markets. And so I think actually by both enlarging the number of participants that have access to it, reducing the friction in that system, which reduces the cost, and then increasing the transparency of it, you actually have deeper, broader, and more stable markets. So democratization is kind of a nice phrase, but I actually think it's this huge phenomenon of actually larger inclusion, more asset classes, and greater transparency hopefully brings greater stability to the market. But that's the hope. With any new rise in asset, there's always kind of unforeseen consequences in a bubble. So I do hold my breath a little bit here.
Thank you, Jed. And yes, I believe we're perfectly on time. So thank you so much to all of our panelists. That was a great discussion, and I hope the audience enjoyed it as much as I did. Hand back to our hosts now.
Thank you, everyone, for joining this fascinating session. Thanks to the speakers. Thanks to Jana for the moderation. Thanks to our partners, London Blockchain Labs and Blockchain at Columbia University. See you soon for the next edition of VALK series. And until then, stay healthy and stay safe. Thank you.